Guy.
Okay, hello everyone. The systems of banks nowadays is a maze of complex, sophisticated terms, yet definitions that I cannot understand thoroughly. But today I decided to try out and decode the enigma behind the banks and the credit cards system. First off, what are the functions of banks? Why are banks created? Now the origin of banks dates back to the 11th century in Venice, Italy, which used to be the center of trade in Europe. Here, the merchant faced really serious issues of, of currency exchange. They have to exchange different currencies every day, and they face the risk of being robbed and carrying heavy coin money on their way along to go trading. So banks are established to solve the problem. Introducing the exchange currencies. They serve as a credible, a trustworthy system to exchange currency at a ratio that everyone agreed on. Moreover, they have the technique of flying money, which significantly assisted the merchants to overcome the heavy weight of money. Instead of carrying heavy coins on their backs, these wealthy merchants will give his money to a bank in Venice in exchange for a piece of paper called a bill of exchange. Or I call BE for short. Now, this merchant traveled to, let's say, Florence. And he gave this piece of paper, the BE, to this bank and received the same amount of money he gave to the Venice bank. The BE is simply a paper that says, well, this paper is worth €100 for this trader. So instead of carrying bags of coins which weigh let's say hundreds of kilograms, wealthy merchants on the way to Europe, to the world of Persia, could carry the pieces of paper in exchange for their true value. That is the art of flying money. And also, the banks in the medieval ages served as the place to lend and save money. That leads us to the second section of this presentation, which is the mechanism behind the banks, the simplified version. If you imagine money as a flow like water, bank is like a pump that regulates and diverts the flow of money so that money can continue flowing and not sit still. Have you ever wondered how banks could give you an enormous amount of loan? Well, let's see how banks work. First off, I have a person, right, who has a lot of spare money, which is the money that they don't want to purchase stuff. They give it to the bank through their saving accounts. And this amount of spare money is granted to let's say a borrower. Who needs money to invest or make a living on through loans. This is called loans or debt, bank debt. And this borrower will have to pay the original amount of loans they've got from the bank, together with an amount of interest. Let's say 2%. And the bank will give the saving account an amount of interest too. That's how the money flow in bank works. To tell you, this is a simplified version of the money flow through banks, because banks nowadays work very sophisticatedly, like through mortgage and credit points, which I do not have enough time to elaborate in this session. But there is a problem in this modern era. Banks are regarded as unethical and greedy. So people have established new alternative models of bank which is more ethical, and they guarantee the interest for their clients. These are four alternative model of banks. The new investment banks, they opt instead of charging commissions through services and financial products, they operate a fee-based model. Like they charge their clients an amount of fee every month or every year. In that way, the advisory services of banks are guaranteed to be objective, and they will work for the interest of their clients, not for the good of the banks. As for the credit unions, they are formed on the basis of a cooperative and shared value, rather than profit maximization. Profits are shared through members of the bank, of this union. And when someone fails, the risk is evenly distributed. So everyone could bear a fraction of it. Not there's bear a fraction of it. So there is no one who will suffer from the burden. The crowdfunding model is like a circumvention of bank as middlemen. In other words, they allow the borrowers to directly reach the individuals who have a lot of money to lend. They do not need any banks anymore. And in that way, risks are evenly distributed. Microcredit is a really ethical way to support the disadvantaged cohorts who are rejected by the banks as statistic. The microcredit support the minor groups whom the bank rejects to grant the loans on the ground that they are unworthy. The microcredits often operate in developing countries to help people to escape poverty. In 2008, there was a really severe financial downturn, and this downturn indicates how banking systems work. Really, but although it is really complicated to thoroughly explain it all to all of you, I could simplify it into simple terms that you can comprehend, I believe. It all started with the FED, the Federal Reserve System of the US, reduced the interest rates in mortgage loans and so on. In that way, banks are now granting the minor groups of people who have no income, no job, or no assets with subprime mortgage loans to purchase a house. In this way, there was inflation, and to control it, Fed must raise its interest rates, which significantly increased the housing price. And suddenly, because of it, people were more cautious when buying house, and demand dropped drastically. And as you know, as demand dropped, the price will drop soon. But here's the dilemma. Let's say a worker borrowed from a bank $200,000 to buy his house. Now his house price has dropped to $120,000. So that means he would still have to pay $200,000 for his loan, but his house only worth $120,000, right? In that way, it's an investment. It was an investment that guaranteed the loss for those who applied for the mortgage debt. And as a result, everyone strategically default on the loan, which is they completely abandoned it. They say, oh, I am not going to pay for it. Yeah. And banks now face bankruptcy as they lend people a lot of money and they could not get it back. Yeah, and then boom, crisis. And then there was something even worse. In this step, let's say a subprime mortgage loan was banks. Sorry. So let's say banks had turned these type of loans into stock assets, and they sold it on the market. To clarify, it means that they sell the mortgage contract to another person. Like the bank said, hey, I will sell you this loan contract, and you will get like $10,000 a month from the loan, and I get, I don't know, 100,000. But the people, but as they strategically defaulted on the loan, those loans on and the stock assets become useless, invaluable, as people could not yield profit from it. So the stock market went on a really severe decline, and this was the financial downturn in 2008. Now, let's move on to friendly, I believe, a friendlier topic, which is the credit cards. The credit cards is just simply the model as buy first, pay later. When you purchase something using credit cards, the bank temporarily paid for you, and at a designated close date, they will announce you the amount of money that you owe them, and you have a period of time to pay it off before reaching the due date. Otherwise, you will bear the high interest of your loan. No, let's say your debt, not your loan. And it is a really double-edged sword in financial terms. It gives a comfort. When we pay for credit cards, we do not have to draw out the money to pay for it. But we just like swipe the card, right? This action completely eliminates the pain of paying, which incentivizes consumers to purchase. It gives you the comfort, avoid the guiltiness of purchasing stuff. But credit card companies apply a really wise predatory lending strategies. Let me explain. They grant you a minimum payment contract, which says that you only have to pay 5% of the money you owe me every month, and the rest, the 95%, you could pay it later. But together with an amount of interest, and that is the core part of this strategy. As the interest is so high that people could barely pay it off, and they stuck in a debt trap, which means they are enslaved by the credit card companies. So how to avoid it? There are very easy two tips for you to control your financial security. Be responsible. You must never buy what you cannot afford. That's the first one, right? Even though there are a credit card that you can pay later, you could not guarantee that you will be able to pay all the amount of money. Since you have reduced the amount of impulse buying, you are now able to pay it off to avoid any charge of interest rates. And that's in the art of controlling your financial flow and avoiding the trap of credit card companies. So, what did we go through today? We have explored how bank systems work, what are the alternative models with, and why there was a financial downturn in 2008. In addition, we learned about credit cards. How credit cards work is really easy, and I assume that you have understood it. And but we delved into the traps that companies use to enslave us, to manipulate us, to purchase more, to pay more for them, and how to avoid it. Just be responsible. And I think this is an